Joining us with an outlook for the oil market is Damian Corvalent. He, of course, is Goldman Sachs head of energy research. And Damian, let's just break down this OPEC Plus meeting today. Brian pointed to this. There's all these questions about what just happened. 2 million barrels per day cut, but that's a technical issue, closer to 900,000 barrels per day. What's that going to do to the market?
I think the key really is the market was already tight. Remember, we're record low on inventories, and we're heading into the end of the year in deficit. This only exacerbates the deficit. So for all the concerns on demand and the macro outlook, this is quite bullish, right? This is going to take inventories from record low to even lower level and set the stage, in our view, for a large rally in prices at the end of this year. So, for us, very much a bullish outcome for the oil market.
Yeah, the Saudi oil minister who was talking there, they have to be proactive, blah, 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 blah. Basically, they're saying they didn't like what happened in the third quarter when oil prices were down 25%. But if you're looking year to date, oil prices are still up 17%. So what gives?
So there are three ways to look at this, right? In the short run, I think concerns, of course, have been on the demand side, potential hard landing. And so, prices have followed down 40%. They're responding to that. The second angle is the decline in oil price has actually been much larger than other cyclical asset classes because the volatility in energy, the uncertainty that we face between Chinese lockdown, Russian sanctions, ultimately have led to an exodus of investors. So oil prices are actually pricing in worse than any other asset class. And that's the second reason for this intervention, is to connect prices back to, as I said, tight fundamentals. The third one is, look, prices are up year to date, but no one's responding on the supply side. There is no investment increasing from here. And so, responding and supporting prices over the medium term is actually necessary. The policies in place, whether it's SPR, for example, releases, do not solve the underinvestment that we have. And so that's the third angle under which to think of those cuts, is we actually need structurally higher prices to avoid depleting inventories even further next year and the year after that.
So I hear your point that they are doing a supply cut. Lower supply leads to higher prices. However, isn't there like the next derivative in this trade where higher oil prices leads to a weaker economy, which leads to a drop in demand? So, how do you balance all of that out?
It's a difficult one, right? So think of the analogy of the 1970s. Think of the Volcker hikes. They came in after a decade of high prices and significant investment in new supply. Today, the Fed is hiking, killing demand with underinvestment for the last 10 years. So this is actually much worse. This dilemma you described is really, you can't have demand because you can't have supply. But if you want to create supply, you're going to hurt demand. So that's, I think, what the market is stuck with. And on average, I think we have to acknowledge that $90 just isn't the price at which anyone is investing. So that's just not a sustainable outcome. And staying here artificially only makes next year's growth outlook, the year after that, even more challenging, because we definitely will see at that point record high prices to finally create supply that no one's investing in today.
Damian, I realize you're not a political analyst, but I will say I was not shocked to see the Saudis saying that they were going to cut 500,000 barrels per day. Not a huge spread, or 500 million barrels per day. That doesn't shock me, doesn't surprise me with any of those things, at 500,000. But hearing that the UAE and Kuwait were kind of on board with this did surprise me to a certain extent. They're supposed to be our allies. I thought if anybody was going to hold out and maybe raise their hand and give us a little bit of room for relief, it would be them. What gives?
So, look, I think the group is operating as one, right? The coalition has been strong, and this decision has been unanimous. It was a very quick meeting in the end. Look, the reality that prices are down 40%, applies to all of them. And in the end, I think the response, which, again, you can argue is either short-term defensive relative to demand, long-term trying to anticipate this supply underinvestment, look, is applies to all of them. In a way, right, cynically if you want, but high oil prices that actually exacerbate the economic downturn are actually bad for all those producers, right? They don't benefit from a recession, neither does China on a global scale. So to some extent, they're trying to thread this, okay, we have to somewhat respond to lower prices, but somewhat also maintain investment. I think they are all very much on the same page here.
Meaning that you don't expect to see additional big cuts to supply?
So, look, I think the next move very much at that point will depend on how the economic outlook shapes in the next few months, and then the Russia shortfall in production once the European embargo goes through. Our base case is this cut today is actually not sustainable. Like, that leads by next year to a significant spike in prices. So we base case it for the next 3 months, but we think it's just not sustainable given how tight the oil market is, because at that point, you really get to that demand destructive price level well above $100 per barrel.
Damian, thank you. Good to see you.